And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to The Investment Show. It is, of course, inflation week. That's right. We get inflation data out this week. Everybody's expecting, well, they really don't know what they're expecting. We've got estimates kind of all over the board. Of course, worries are that inflation may come a little bit hotter than expected. That, of course, would delay potentially any Fed rate cuts. And, of course, the market's been rallying here over the last several days on hopes that actually the Fed is going to cut rates. In fact, the number of expected rate cuts are now up to 2 this year. From the market. The market was expecting 7. They got down to 1. Now they're back up to 2, and the market really hasn't done a whole lot. So, the market's been going up. It's been doing well. The expectation for Fed rate cuts kind of all over the place. And of course, the narrative for why the market's going up continues to change, right? So it was going up because the Fed's going to cut rates 7 times. Now it's going up because of AI. I mean, the narrative changes to help support whatever's happening in the overall price movement of the market. But couple of things coming up this week. So tomorrow I have an article coming out talking a little bit about narratives. And, one of the things that we continue to see really kind of across the media is a lot of very bearish kind of views about the economy, about geopolitics, whatever it is. So, lots of disaster scenarios. And underneath the surface, what's been happening is that markets have been continuing to improve. And so tomorrow's narrative looks at a study that we do every week in our weekly newsletter, which is our risk reward ranges. And every month we evaluate the risk ranges for most, every major market, every major sector. And part of that is telling us that the bullish narrative, right, the bullish drive to the market, I shouldn't say the narrative, but the bullish trend of the market is very positive and suggests that this market is going to continue to do well over the course of this year. Doesn't mean we won't have a correction along the way, but there's certainly nothing that the markets are expecting really across the board, across all major sectors, whether it's bonds or whether it's stocks or gold or anything else. They're all back on bullish buy signals, and that typically tends to last for a while. So again, no reason to be sitting in cash. And in fact, this is one of the things that we've talked about recently, is that yes, cash provides liquidity, it provides an alternative, but hiding in cash because you're expecting some major economic upheaval doesn't necessarily help you build your financial wealth. And so again, that's why it's always important to kind of step back. So we go through that analysis tomorrow. We'll go through it on the show as well, but it's a very interesting kind of turn in that risk range report that we publish in the newsletter every week. We've seen a definite turn towards being positive from being very negative, of course, in October of 2022. So again, not surprising. Outside of that, though, economic data continues to kind of be a mixed bag. We've seen some manufacturing reports come in weaker than expected. Services actually a bit weaker than expected here recently. So we'll see if that continues to deteriorate. Of course, the big concern here is about consumers, their ability to spend, where they're getting money from. And, we've talked before about consumers are very creative about where they can access funds. And so when they run out of savings in their savings account, they turn to credit cards. And when those get tapped out, they turn to retirement accounts. And that's one thing we're actually seeing right now is a very big increase in the number of people both taking withdrawals from their 401k plan as well as hardship loans. And of course, if you take a withdrawal from your 401k plan and you're too young, right, you pay the 10% penalty and taxes. So again, that can really set you back on your retirement savings. But we're seeing that increase. And this is suggesting that more and more people needing to access funds that they shouldn't be touching, but they don't have an alternative. If they want to continue to pay bills, make ends meet, of course, that is that economic stress that we've been talking about for a while. So again, slower economic growth likely over the course of this year as that continues to go on. But flip side of housing, it's doing great. Consumer confidence out last week. Big drop in consumer confidence, but ironically, in that drop in consumer confidence, the number of people expecting to make more money from the stock market surged to a record high. The number of people that are expecting higher home prices over the next 5 years, near an all-time record, but home affordability at record lows. So, it's almost a dichotomy of what you want, right? And there's no way to fix that, because if you want more home affordability, home prices have to come down. That's it. I mean, there's no other way around it. Either you build a lot of supply, which drops the demand, or something else has got to happen. But until that occurs, this big gap between what people feel about assets and their confidence about their assets, housing and stocks, and of course the affordability of being able to buy a home are going to remain a very, very big gap. Okay, let's talk a little bit about the market here. So we talked about this correction over the, previously back in April. We had the correction, kind of bounced off support. We were running along that 100-day moving average as support. We said, hey, if the market breaks above the 50, that's going to potentially set us up to retest highs. That's exactly what we're doing right now. We're back here to testing these highs from March. Futures are up a little bit this morning. We're likely to kind of struggle in here for a few days. I wouldn't be surprised. I mean, the market's been up now for about 8 days in a row, more or less. So again, we've just had kind of a very big surge coming off that support. We had that correction. Buyback window opened back up, as we talked about. That's led to this big surge of buying. So on a solid buy signal right now, markets are back to overbought. So again, I would expect this market to kind of just a few days, right, just kind of struggle here a little bit, maybe not make much of an advance. But again, if we can take out these highs where we were back in March, then there's no resistance above that, so the market can certainly climb higher. The month of June and July tend to be fairly decent months in election year. So again, there's really not much capping the market from moving higher here. other than just very, very overbought short term. But again, you can remain overbought for longer than you expect. And with the buy signal coming from a fairly low level, there is upside potential here. So again, no real reason to be overly risk averse at this point. Make sure that you have your exposures where you need them. I would wait if you're looking to add exposure. I would be a little bit cautious here about adding exposure, just simply because, again, we've been up 8 days in a row. It's been a very big advance. It's been the biggest advance for the Dow in like 3 years. So again, a very, very big advance across the board. So again, just a little bit overly done here just in the short term. So if you need to add exposure, look for a day or two where the market kind of pulls back, consolidates a bit, maybe works off some of this overbought condition. Again, I wouldn't expect a lot. The bullish trend, as long as this MACD buy signal is in place and is rising, the push will be for higher asset prices here, at least in the short term. But again, a day or two where the market gives you a pullback or some position that you're looking at gives you an entry point, that's where you want to take advantage of it. Just kind of be a little bit careful how you do here, because again, we are just a bit extended. And again, no big deal here. I mean, again, the bullish trend very much in place. There's not a lot at the moment that should undermine that, with the exception of a hotter than expected inflation report. If that inflation report comes in this week much hotter than what expectations are, that'll certainly give us a pullback in asset prices as markets begin to rethink the ability of the Fed to cut rates. But that's your risk for the week, and so we'll be watching that very closely. Of course, we'll talk about it when it occurs, and we'll go from there. All right, that's what you need to know before the bell this morning. When we'll come back, we'll talk a little bit more about the markets, economy, what's going on. Don't go away. More of the Real Investment Show coming right up.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So as I said, this week, kind of the big driver for the markets is going to be really the inflation data. And again, it's unfortunate that we have moved the market from actually talking about fundamentals and the things that are important to what's the Fed going to do. I mean, this is the whole driver for the market, right? So, and if it's not the Fed, it's AI. So it's one of the two. But, primarily it's the Fed. What's the Fed going to do, right? Are they going to cut rates, provide more liquidity to the markets? And this is just really what we've done since 2009. So, in 2008, of course, had the financial crisis. A lot of you guys watching the show right now, way too young to remember that. But, that was the change, right? At that moment, and it had happened to a little lesser degree under Alan Greenspan back in the dot-com crash, but not nearly to the degree that it occurred in 2008. Because in 2008, once the Federal Reserve stepped in and started doing quantitative easing, started doing, assisting in all the different types of bailouts, dropping interest rates to zero and keeping them there for a decade roughly, that changed the dynamic from fundamentals to the Fed. And so for the last 13, 14 years now, it has become the issue of, well, as long as the Fed's providing monetary liquidity, then asset prices go up. And so that's all we really need to know. We just need to know what the Fed's going to do, and that's going to tell us what the market's going to do. So if they're providing liquidity, then and providing accommodation by low interest rates so I can leverage, then asset prices will go up. And it's a fair statement, right? It's a fair argument because that's exactly how it works. Unfortunately, that's just not the, trying to buy stocks based on fundamentals or, long-term views, those type of things, just simply is kind of the second chair. Doesn't mean they don't matter. I'm not saying they don't matter at all. I mean, you should always buy companies that have fundamentally strong earnings and balance sheets and those type of things because they will save you in a market downturn. We saw that a lot in 2022. In 2022, the market was only down 20%, peak to trough, right? As 25, peak to trough, but finished the year down 20. But a lot of those stocks that were the darlings of 2020, 2021, that had no earnings, had no, really strong fundamental balance sheet, but were up huge based on this idea of work from home and a lot of just speculation by, young people getting checks and jumping on a Robinhood investing account, buying stocks. Those stocks did great in 2020, 2021. They lost 90% of their value, a lot of them, in 2022. So those stocks were down 90%. The market was down 20%. So my point is that fundamentals will save you during a market downturn. So, don't disregard fundamentals entirely because fundamentals matter. But it's not what drives the markets. When markets are rising, what drives the market, of course, is whatever the theme of the moment is. Whether it's disruptive technologies, 2020, 2021, right? It's all about disruptive technologies and ESG. That was the theme. Well, when that all fell apart in 2022, we had to come up with a new theme. So the new theme's AI now. It's generative AI. And the expectations are now that generative AI is going to generate trillions of dollars worth of opportunity over the next few years. And of course, all this private equity money that's sitting out there is just funding look, if you want private equity to throw money at you, just come up with some type of AI deal. Do something with AI and you can go get private equity money because there's so much money sitting out there in private equity trying to get into AI. There's just not enough deals to fund them. So again, this always happens. This always occurs. I mean, we saw the same thing with disruptive technology. Everybody coming out with, hey, I'm going to create a direct-to-consumer healthcare app, right? And money would just flow into it. And of course, 90% of those went to zero. But there's always the one, right? And that's what private equity is looking for. They're just looking for the one that they can get to go public because whatever they lose on anything else will be made up by the one that goes public. So you come up with something AI related, private equity money standing there to throw money at you. But this is the new theme. It's the new mantra. And look, I mean, there's definitely a case to be made for AI. Is it going to be the game changer that everybody thinks it is? I remember back in 2001 and 2, as the internet really kind of came of age at that point, we were really starting to move everything towards .com and all that stuff. And the theme at that time was the internet of everything. Everything was going to be connected to the internet, right? Your refrigerator, your washer and dryer, everything would be connected to the internet. And some of it is, right? I mean, we've definitely seen that. I mean, you've got refrigerators that have a glass panel on the front door, and it'll tell you, what you're out of when you get ready to go to the grocery store. Show you what's inside the cabinet, right? It does all kinds of things connected to the internet. But the massive expansion of valuations and benefit to the companies that made those products didn't ever really mature to the degree that everybody thought it was. And that's pretty much now. I mean, when you take a look at a chart of this generative AI expected, revenue growth that's going to come from this, I mean, it's just a 45-degree angle higher every year going out. So over the next decade, we're just going to be throwing trillions of dollars in generative AI. Maybe that's the case. But things happen along the way. Right? First of all, the technologies get cheaper. More competition leads to lower prices. And things don't always mature at the growth rate that we expect them to. Right? Maybe everybody, if you've ever seen the movie Ready Player One, everybody's connected to, the internet, so to speak, and right, they're in this virtual meta world, right? It's kind of the dreams of meta that ultimately one day we'll all be living inside this virtual universe, and real life sucks, and so we're all hiding out in this virtual universe. Maybe that's where this winds up. Maybe we do hit these astronomical targets on valuations and prices and flows and all this other thing. Maybe that's the case. I'm not saying it's not. I mean, it's definitely the trend right now. All I'm saying is that these themes, these thematic themes, whatever they are, they do change over time. And so as investors, we have to realize that there are limits to everything. And that while AI and everything related to AI right now it's utilities are getting into the case, right? Because we've got to provide the electricity and the infrastructure to support the AI. That's certainly kind of driving the market across the board. And these themes are very bullish, and they can support asset prices for a lot longer than you think. And they can push prices much higher than you think when we're in the midst of one of these thematic events. But things will change. Whatever causes it to change, whatever happens, whatever the new thing is, right? I mean, there's going to be some invention that comes on down the road in 5 years, 10 years from now that changes the game again. I don't know what it is, but it'll be something. And so again, it's just important to remember that it's always important to participate. And this is why it's so important not to make and as I was saying earlier, talking about narratives and all this type of stuff. Remember, a couple of years ago, it was the death of the dollar. The dollar was going to die. Now we've got a dollar that's raging strong, and you've got central banks that are buying gold everywhere else in the world to hedge off the dollar because the dollar's getting too strong relative to their currency. So they have to buy gold and offset reserves. And that's it. I mean, they're not stockpiling gold because they think the end of the world's coming. They're trying to hedge currency risk. When that currency risk is over, when the dollar declines, so will gold prices and everything else because they'll start to sell their gold. But, that's why it's always important to understand what are driving these narratives so that you know when to change your investment strategy. Again, being adhered to one thing, whether it's AI or whether it's fixed income or whatever it is, being adhered to one thing, indefinitely doesn't work because things are going to change. At some point, inflation is going to come down. Interest rates will approach, 2%-ish again. And you won't want to own bonds anymore because you will have capitalized on all the return out of bonds. That'll be it. And so you'll have to have another narrative after that to buy into, right? So where's the money go after that? And this is always the case to ask yourself is, okay, this is fine for now. This is going to last for 2 or 3 or 4 years, 5 years, whatever it is. I mean, these trends tend to last for a while. There's no doubt about that. But the question you always have to ask yourself is, okay, then what next? Right? So as an investor, it's like, okay, then what next? Where do I go to when this thing is over, whatever it is, where do I go next? So again, right now, everything's fine. Everything is moving in the right direction. That's exactly what we want to see. But just always keep in the back of your mind that this is a thematic trade in terms of AI and its related associates. The question you always have to ask yourself is, okay, what changes? And when that changes, and it will, whether it's 2 years from now or 3 years from now or 5 years from now, whenever it is, okay, then what next? All right, quick break. We'll come back. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare. Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I complain about inflation at my house all the time. I yell at my wife. I don't really yell at her. I don't really say anything because she'll yell it back at me. But in my mind, I'm yelling about how much stuff is costing, and then I just go on about my business.
The Real Investment Show podcast.
Mike understands this. He's the same way. Mike and I have a lot of arguments in our head that never leave into verbal space with our wives.
At realinvestmentadvice.com.
She scares me.
Hey, mine too. It's okay.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So let's talk a little about earnings as we have now pretty much just wrapping up earnings season. We had a few companies out today, GameStop, BuzzFeed, Tencent Music. I mean, most of these are smaller companies now. We've pretty much finished the S&P 500 for the most part. The NVIDIA is still hanging out there. That comes later this month. But that's really the only big name kind of left for the S&P. But so earnings are a function of economic growth, right? And I know this is kind of hard to wrap your head around in a lot of cases because, you just take a look at earnings and they just keep going up all the time, right? But revenue has to come from economic activity. So if revenue is going to continue to grow, so does economic activity. Because what you and I spend in the economy, our activity in the economy is where the revenues come from. In other words, you pay your Apple iCloud, fee every month. You pay your online subscriptions every month. You pay your, you buy gas, you buy food, you buy a new phone, whatever it is. That's where the revenues come from for these companies. I mean, the revenues just don't magically appear, but revenues are what happen at the top line. At the bottom line is the earnings after all their expenses and all their manipulations in terms of like stock buybacks and everything else. And that's how you get to earnings on the bottom line. So ultimately, earnings and economic growth must track each other. They must. And so this is something I kind of touched on in this weekend's newsletter, is that there's some interesting things that are going on with earnings right now that is worth paying attention to. Estimates for GDP growth right now are surging. So coming into this year, economists were expecting a very slow year of growth, economic growth, basically about flattish. Now remember, 2022, everybody expected a recession. 2023, still expected a recession. 2024, no recession, economy's going to boom. And so, we've seen economic growth estimates now ticking up to around 2.4%. That's, like I show you in this chart. So we've just had a very, very big increase since really October, when kind of everything bottomed in October of last year. Economists are getting very excited about the potential economic growth for this year. Now, whether or not we achieve this rate of growth is going to be an entirely different story. But right now, Atlanta Fed has economic growth projections for the second quarter sitting around 4%. So again, not shabby, to say the least. But again, there's a very high correlation. We take a look at the annual rate of change in economic growth and the annual rate of change in earnings. It's not surprising there's a very high correlation. Now, the outliers from that are all points where things broke. In other words, you had the pandemic, you had the financial crisis, etc. The reason is that during an economic shutdown, as an example, earnings fall through the floor, right? Or during a recession, immediately everything kind of goes cattywampus and everything kind of blows out to one end or the other. And then coming back from that, you have these explosive rates of economic growth. Because remember, it's all about it's about the percentage rate of change, right? So you can have these very big moves in earnings that are far outside the economic growth rate, right? Because of the way that we calculate earnings at the bottom line. But historically, there's a high correlation, as you would expect there to be. Here's what's interesting that's going on with earnings right now. So earnings are expected to have troughed back during 2022 in particular, and in early 2023. And earnings growth is expected to grow rather rapidly over the course of this year and really into next year. We're expecting to get well over $250 a share in earnings by the end of 2025. So lots of expectations for very strong economic growth. one of the things that is going to pose a challenge to that is the continued reversal of monetary input, right? So, we had this massive surge in M2, which led to a lot of unprecedented economic activity, big surge. That's reversing, and that's going to continue to reverse as M2 as a percentage of GDP continues to decline. And that will continue because, it will continue unless there's another big spending bill along the way. And if we just take a look at the rate of change in M2 versus economic growth, we can see that the trend of economic growth is going to be slower, at least for a while. Now, M2 is going to come up here a bit. It's just going to start to normalize because, it's just the year-over-year rate of change. So we're going to get back to zero, and then monetary supply will grow a little bit just because of economic activity. But eventually, GDP is going to catch down to where monetary supply is ultimately. And so the importance about this is that earnings are a function of economic activity. And so the reason the markets are going up right now is because earnings are growing, and those are expected to kind of grow nonstop here over the next 2 years as generative AI and all this other stuff is kind of going on. So that's why asset prices are rising. And there's a very high correlation, obviously, between if earnings are declining, so are the markets, and vice versa, because markets are going to price off of earnings to one degree or another. Here's the interesting thing, though, about earnings. Yes, we are having earnings growth. It's only coming from the top 10 stocks of the S&P, and primarily it's only coming from the stocks that are also in the NASDAQ. So Apple, Microsoft, Google. That's where the earnings growth is. If you strip those guys out, the S&P is not growing earnings. This is where the conundrum comes in, right? Because we look at the broad capture of earnings. And so from the broad capture of earnings, yes, earnings are rising, so asset prices go up. We get that. We understand that. The quality of the earnings are a very different story. Who's actually growing earnings versus who's not growing. And this also has a lot to do with the bifurcation of the market. But also the rate of growth in those top 10 stocks is going to slow as monetary supply reverses, as spending reverses, as the economy slows down. That growth rate in those companies is going to reverse. So unless there is a transition of earnings growth from those top 10 stocks to every other company in the index, which is likely not going to be the case, the growth rate of the S&P 500 is going to slow down. In other words, we're not going to grow at 10 or 15% clips every year like we were over the last 10 years. We'll probably grow somewhere between 4 and 6%. And for a lot of people who have just really gotten used to high rates of return in the market every single year over the last decade or so, it's going to feel disappointing. It's like, man, this market sucks. It just doesn't ever go up anymore. It was up 4% last year, 5%. Right? But that could very well become the new normal. I'm not saying that's the case, but I'm just saying that could become the new normal because as the ability for companies like Apple, right, who hasn't grown revenue in 4 years, their whole growth rate's based on their buybacks. With the addition of the $110 billion in buybacks that Apple's doing now, they will have almost bought $700 billion worth of stock back. I mean, they're approaching buying $1 trillion worth of stock back at some point over the next few years. That's a lot, right? But that's how they're manufacturing the earnings because the revenue growth really isn't there. And so at some point, the ability for these mega cap corporations, it's just a function of, it's the law of large numbers. I just can't grow earnings at the rate I used to. Right? I'm no longer a growth company. I'm just a fully mature company. I'm going to start growing at 4, 5, 6%, whatever the economy is. And that's going to become much more challenging for the markets in terms of justifying valuations at some point in the future. But again, for now anyway, buybacks are the story. The question is, of course, is that can the market continue to just survive on buybacks alone? Because the problem with buybacks is that if you're not issuing new shares to buy back, eventually you're going to buy back your company, right? So eventually in a few years, maybe we don't have a market, right? We just buy it all back. Now, that's I'm being a little bit facetious here, but you get the point. There are limits to all of these things that we can do to manufacture earnings. At some point, it's going to come down to real economic activity. And the question becomes whether or not we can continue to sustain current economic growth rates when we're seeing the underlying scenario of the economy where people are having to take money out of their 401k plan just to make ends meet, right? Buy now, pay later programs, credit card debt, etc. There is just a lack at some point to continue consuming at the pace that you're consuming, which means you get slower economic activity. Now, it doesn't necessarily mean a recession, right? It could, and recessions are certainly a normal part of the cycle. So I'm not saying, hey, we're not going to have a recession. I'm not saying that at all. And it doesn't necessarily mean that the world's going to crash and fall apart, but it does suggest that we're going to have much slower rates of economic activity, which will lead to slower rates of earnings growth, which will lead to lower rates of return in the future, which would be justified by high valuations where we are now. So, this is one of the challenges. So in the first segment, we talked about, the generative AI and this, this massive expansion of earnings growth that's expected to come from generative AI. This is the other side of that story, which is great to have all this AI stuff. You just got to have somebody consume it. And this is going to be the challenge for markets as we head into the future. Okay, quick break. When we come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
So you're ready to retire, but are you ready to transition to Medicare? Knowing how health insurance works after you leave your job is vital. Our next Lunch and Learn will tackle transitioning to Medicare, Wednesday, May 15th, with Danny Ratliff and Richard Rosso. How do you sign up for Medicare? And how will it work with the insurance you already have? Food for thought and food for your belly. Register now for our Transitioning to Medicare Lunch and Learn with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, there's always something bad for us, right? And every time we kind of get into life, it's like you're eating something and all of a sudden it turns out that causes cancer or whatever it is. And so we go through these phases where it's like, hey, we're doing this and we're all eating this now. And then you find out later, oh, that causes cancer or some other bad, kind of side effect of, eating or drinking, whatever it is. But good news out this morning from the Epic Times. Enjoying a cup of Joe can offer more than just a pick-me-up. That's good because every morning, coffee. This show does not operate without coffee. That's just all there is to it. Too damn early in the morning. It has been shown to have numerous health benefits, especially for people like me, older, because I just got older yesterday. Research has found that natural molecule in coffee can help improve age-related muscle loss and maintain muscle functioning during aging. So apparently I'm not drinking near enough coffee. So I need more. I want to look like Arnold Schwarzenegger before it's all over. Muscle mass and function generally decline as we age. Has a lot to do with, loss of testosterone, a whole variety of other issues, potentially leading to sarcopenia. This can hinder mobility and even result in dependence and disability. The hallmarks of sarcopenia include a decline in multiple levels of NAD and mitochondrial dysfunction. So this is a study that was published by the Nature Metabolism in March, and it was found that drinking coffee actually has good benefits for you other than just, Now, when we're talking about drinking coffee, we're talking about drinking coffee, maybe with a little bit of milk or cream, okay? We're not talking about the Starbucks Cafe Macchiato that is just full of sugar and all the other stuff, right? So, no, that's not drinking coffee. If you want to drink coffee for a health benefit, you drink it black or with maybe just a little bit of cream, just a splash of cream. That's it, milk, whatever. So I use fat-free milk on mine. So just a splash, fat-free milk, black coffee. So I just need something to take the edge off the bitterness, right? So, but no sweetener, no sugar. Got it. Starbucks doesn't count. So that leads to what they call the diabetes, right? So you drink the cafe macchiatos, that's great. You get the diabetes. I know how it's pronounced. I'm just making fun of Wilford Brimley. If you don't know who Wilford Brimley is, go look him up, right?
It's good and good for you.
Exactly. Everybody's like, again, watching movies lately, I'm starting to realize how old I am because everybody's about to die. So we're, all my favorite actors, they're about dead. So we're getting to that point.
Not enough coffee.
Absolutely. Yeah, absolutely not. I do like that they do include in here. The study found that drinking 3 to 5 cups of coffee a day, that's a bit much, right? 3 to 5. I don't know. That may be about normal. Per day in midlife was associated with a 65% lower risk of developing dementia. Oh, I'm in good shape then. No problem.
Oh, yeah.
But another study found that compared to light coffee drinkers, 1 to 2 cups a day, which don't have to worry about that. Heavy coffee drinkers, more than 6 cups a day. Now, that's a lot.
They had to peel those researchers off the ceiling.
That's what I'm thinking. What are you talking about? I'm becoming fine. Non-coffee drinker, those who drink more than 6 cups a day versus non-coffee drinkers, and those who drank decaffeinated coffee had higher odds of developing dementia. So there's this sweet spot, right, of coffee drinking. More than 2, but less than 6. So 4. It's a happy medium. So drink 4 cups of coffee a day. That's the sweet spot.
Live forever.
Yeah. So a study published in the New England Journal of Medicine in 2020 showed that consuming 3 to 5 cups of coffee a day was, again, split the difference. You got 4. Was associated with a reduced risk of several chronic diseases. I still have this annoying pain in my ass, though.
What?
Yeah. Drinking coffee doesn't resolve that issue. Of course, my wife is traveling this week, so it's going to be a good week.
And she's out of earshot.
That's not true. I'm just teasing. I love my wife. She's awesome. However, considering that excessive caffeine intake may have some adverse effect, it's recommended that adults who are not pregnant, which that can be male or female these days, and are not breastfeeding, I guess that can go to both sexes as well these days, yeah. And while pregnant and or breastfeeding, which can go both ways now, should limit their intake of caffeine to 200 milligrams. So there you go. That's all. Look, just drink 4 cups of coffee a day and don't be pregnant or breastfeeding. If you do that, you're going to be in good shape, and apparently that will help extend your life and keep you from losing as much muscle mass, which is a big challenge as we all get older. I can tell you because I go to the gym every day, and it's good. Every birthday, it gets harder and harder to push that same amount of weight, or to increase it. So trying to increase weight is the harder part.
There's probably a chart in the making on diminishing returns.
Probably.
Yeah.
I don't adhere to that because, see, mentally, I'm only 20. So,
hey, yeah.
Mentally, I can still push that same weight I was pushing back in my 20s. So
Yes.
I'm going to continue to do that until something literally breaks.
It'll be Lance's last chart.
Exactly. My last chart will be, his knee is in 4 different directions now from squatting. So, but anyway. But more coffee ahead of time.
Yeah.
Yes. So this is
A little more coffee, brother.
Yeah. All right. And yes, along with coffee, there's comments here: too much protein, too much fat, too much carbohydrates. There's a delicate balance to everything, right? And that's why I don't use, personally, I don't do any of these crazy diets like keto or whatever. I just eat a balanced, healthy structure, moderate my intakes. I do a bit of macro counting to, try to keep the balance, but it's not difficult. It's just a food choice lifestyle that you make. So, and no, Donald, I do not agree with limits. No person has limits. At least I don't in my mind. And my mind has no limits. I can do anything. My body may disagree. Which is why I probably take aspirin every morning now. But anyway, getting ready to wrap up the show this morning. Okay, so today, not much out today. We have inflation expectations this morning from the New York Fed, a little bit of earnings. Wednesday's the big day. Consumer Price Index, which is both core and headline. And that's expected right now to come in at a 0.4 expectation versus 0.4 previously. So expectation's actually pretty high. And so there's a good bit of data out, or a good bit of commentary out talking about that this inflation print could come in cooler than expected. Well, part of that is because you've now kind of pumped up the expectation. So normally we're going to grow at somewhere between 0.2, 0.3% on CPI. So if you've got a 0.4 print, the odds are pretty good. You're going to come in odds are going to come in that you're going to come in cooler than expected. So that could help support markets on come Wednesday. But outside of CPI, we are also going to have the real hourly earnings. Earnings have not been keeping up with inflation. So again, that's kind of a big problem there. And of course, retail sales on a month over month, that's going to be the other big story to kind of keep a watch on, is the consumer, which has been pretty strong, right? So in both March and April, we saw fairly strong, in February and March, we saw fairly strong retail sales coming in. Now, April, everybody got a tax refund. I shouldn't say everybody, but people got a tax refund. So April retail sales could actually be pretty good because of that. But outside of that boost, remember, so in February, we had Valentine's Day, so people bought a lot of stuff. In March, you had both Easter and spring break, which helped boosted spending. April, you have tax refunds, which people run out and spend. So that boosts spending. But once you get past April, not a lot. Right? So the month of May, outside of my birthday, there's not much to spend money on. So, by the way, I have a new series coming out. I'll tell you real quick. My wife bought me a GoPro for my birthday because I was out so every weekend we take long walks in the park together.
And we take our dogs with us. Well, one of my dogs, his name is Sniper, he likes to chase squirrels. So I'll let him off his leash and I'll let him go chase squirrels, and then he comes back. So I was joking around the other weekend that I think I'm going to attach a GoPro to him, and I'm going to do a series on TikTok called Sniper Hunter, which is, he's going to go out and hunt these squirrels. He never catches them. So it'll be like Sniper 0, Squirrels 183 will be the scorecard. So she bought me a GoPro. So I'm probably going to be forced into launching this new channel called Sniper the Squirrel Hunter coming out soon. So it'll be him chasing squirrels in the park. So
we can monetize that.
Yes, we will try to, we will just show clips of it on the show in the morning. So that was my birthday present. We'll see how this turns out.
Change up the intro.
Exactly. Crikey. Here we are in the deep forest of Houston, Texas. All right. Wrapped up show for today. All right, we'll be back tomorrow. We'll be serious tomorrow. We got stuff to talk about in the morning. I have an article out in the morning talking about risk reward and what it's telling us about the markets. Now, on Friday, I've got an article coming out talking about Berkshire Hathaway's warning that was in his annual report that a lot of people just kind of glossed over. But there was a very interesting warning about the stock market in his annual letter. And so we're going to talk about that on Friday in that report. So that's all coming up on the website, realinvestmentadvice.com. Have a great day. We'll see you back here tomorrow.